Oil prices climbing today and on pace for the biggest weekly gain in about 2 years, boosted by rising tensions in the Middle East. Joining us now, we want to bring in Claudio Galimberti. He is Rystad Energy's chief economist. Claudio, it's great to have you. So we've seen this massive move to the upside here. You see crude and Brent both pushing even further to the upside here today. I think the big question investors are asking, at least when it comes to crude, whether or not we're going to push above the $80 a barrel limit. What do you think?
Thank you for having me back. That's a distinct possibility. We are very close to that. And the tension in the Middle East is one of the highest level in 4 decades. Now, we should ask ourselves why iron price is higher to some extent. And that has to do with the fact that we have a lot of spare capacity in the Middle East. So we have come from basically 2 years of successive production cuts. And right now we have places like Saudi Arabia and UAE that sit on 4 or 5 million barrels of spare capacity. So that's keeping a lid on prices. But there is an enormous amount of production taking place in the Middle East. So if we are going into an escalation phase and if we are going into an all-out war, then the oil markets can really be on a tailspin upwards. So $80 per barrel is definitely something we can see the next few days.
It seems like the cap to that, Claudio, would be whether or not, as part of that escalation, there was any impact to the Strait of Hormuz. What should investors be watching for there to really understand what that might do to the price action if there was any escalation that specifically impacted that strait?
Absolutely, and it's good that you raise this point because in some cases traders have started to buy call options at $100 per barrel strike price, which clearly shows that there is this possibility. So let me give you just a couple of important numbers. So we quoted the spare capacity in the Middle East. Let's call it more than 4 million barrels per day, between 4 and 7, depending on how you count it. Let's talk about the possible supply disruption from Iran. Iran is clearly one of the 2 parties in this war, and they currently export 2 million barrels per day. So if Iran was to be impacted, then this could be addressed with the spare capacity coming from Saudi Arabia and UAE. Strait of Hormuz is on a different lead. We're talking about 13 to 50 million barrels per day of oil going through the Strait of Hormuz, and this is just crude. On top of that, we will need to add LNG, we will need to add oil products. So if the Strait of Hormuz, which has been patrolled by the US Navy for the past century, was to be impacted by the war, then all bets would be off because there's nothing that can then address basically a blockage of the Strait of Hormuz. 40 million barrels per day would be akin to more than 15% of crude production. So it would be completely unprecedented.
Claudio, I know it's very, very hard to predict, especially in a situation like this, but I guess just in terms of what you're forecasting, how likely is that?
That's indeed, that's extremely difficult to predict. We definitely are not in the business of predicting anything relating to military kind of escalation. But let's put it this way, if history is any guide, then very unlikely, right? So as I said, for all the problems that we have seen in the Middle East for the past 80 years, the Strait of Hormuz has been working fine. And as I said, it's been patrolled by not just by US Navy, but primarily. Clearly, we are facing, as I said at the beginning, a situation which is we have not seen in at least 40 years, I would say, and the possibility of of a direct war between Iran and the neighbor, specifically Israel, is at this point quite likely. So that is something that the traders are now starting to price in, right? So if you see really from, we're currently at $78 per barrel Brent, you see call options being bought at $100 per barrel. That's clearly factoring in something of a big size, big proportion, let's call it a big supply disruption.
Which of the refinery operations are most exposed, are most vulnerable here? Thinking about Exxon and Chevron and, where investors need to be monitoring the spillover effect here that could impact how they're able to move their supply around.
Excellent point, because who is present in the Middle East? Well, we're primarily obviously talking about the big NOCs, right? So the ADNOC, the Saudi Aramco, the other big NOCs in the Middle East. But if you think about the majors, actually, they have a relatively low exposure, specifically when it comes to oil. The Exxon is primarily present in the Americas, Chevron also in the Americas and in West Africa. Shell is more evenly distributed across the globe, but it only has a relatively limited exposure to the Middle East. If you think about primarily in this case, it would be Qatar and the LNG. So Total similar, probably slightly more than the American counterparts, the exposure to the Middle East. But clearly, the impact of a Middle East war would be on the Middle East producer, and the big majors have very, I wouldn't say very little exposure, but definitely they're much more exposed to other parts of the world, primarily America and West Africa. So from that standpoint, if you're an investor, purely from this standpoint, the major would stand to gain in a situation for a big supply disruption in the Middle East.
All right, Claudio Galimberti, who is the Rystad Energy chief economist. Claudio, thank you so much for taking the time here today. Appreciate it.
Thank you so much.